the RBI has expended reserves to defend local rates in a way, to defend the currency, and it's the right thing to do, possibly because these are event risks. You do not know how long they'll last. But the fear is that if this uncertainty, like I said, continues into next year, even the RBI may be required to review its position, because India's balance of payments still remains negative. Our exports are weakish at the moment. Yes, oil prices are down, but the trade deficit isn't. The current account deficit isn't down yet. So if at some point the RBI realizes that it cannot continue to expend reserves, then you will see a tightness in Indian liquidity as well. And Indian rates will also have to rise faster in order to then start reflecting the global macro. That's the risk to us if this uncertainty continues into, let's say, middle of next year.
India's problem right now is to ensure that there is macroeconomic stability, because we have reached that point where traditionally India becomes very vulnerable. When you go beyond that 2.5-3% of current account deficit, when you go into double digits of fiscal deficit, and as proof of the pudding, in what RBI has already intervened, $80 billion. Again, you can point to massive amounts, levels of FX reserves, but it's not the level that matters as much as the burn rate that matters. And already people are talking about, well, should the RBI be wasting money in defending the currency? My point is that it is macroeconomic stability that needs to govern what RBI plans to do and what the government plans to do on the fiscal policy, rather than this.
Because commodity prices have shot up so much, it used to be 1.5% for 6 years before the pandemic. India's current account was very timid. The quarter that passed, it was probably 3.5%. This quarter, it's probably tracking above 5%, and for the full year, it will be 4% of GDP. Now, no reason to panic, because the RBI is sitting on a war chest of FX reserves. As I keep saying, reserves to imports are 9 months of coverage, very comfortable. Reserves to gross financing requirements looking ahead are 1.5 times, again, very comfortable. So this is not 2013, there is no panic here. The question is, how do you bring external imbalances down without extracting a high price on growth? Because there are two ways to bring the current account down. One is to slam the brakes on growth and to choke imports off. And we certainly don't want that. India is still recovering from the pandemic. We're still not back on our pre-pandemic path. We need to get back on that path. So we don't want to overly squeeze growth, which is why my prescription has been, let's use the real effective exchange rate. If the exchange rate were to depreciate in a calibrated manner, over time, research has found it helps exports. It will discourage imports and people will move towards domestic substitutes, and the current account will narrow. So you get the narrowing of the current account and you get it in a growth supportive manner, because a weaker exchange rate is actually helping growth over time. Now, of course, easier said than done. This is much more of an art than a science. But for me, that needs to be the kind of division of labor, that the exchange rate is used in a calibrated manner to solve the current account issue. Monetary policy is normalized and front-loaded to solve the inflation issue. And fiscal policy within its constraints still uses capital expenditure to help growth.